Good morning to all of you. FinnCorn's been working with ECA to examine the competitive retail energy industry with a focus on the evidence available from retailer disclosures, particularly the long-term data series provided by ASX-listed AGL and Origin to their investors. This is over 10 years of reliable, consistent operating and financial data, spanning the rollout of retail energy deregulation through the main NEM regions. Sampling AGL and Origin allowed us to develop a useful hypothesis of competitive market structure and performance. This has directly informed the Thwaites Review and the ACCC inquiry, which found supporting evidence within the broader sample data that the ACCC were able to collect. The questions we raised are increasingly being examined in reports by others, and the AMC's latest Retail Energy Competition Review is a very good example of that. While we see that this is progress, the ability to look comprehensively at the sector and to draw firm conclusions rather than hypotheses based on an incomplete view remains reliant really on the ACCC's information gathering powers. We suggest that a basic standard of disclosure should extend to all retailers, informed by the listed company benchmarks, and much of this should be publicly available to stakeholders. This would allow reliable and efficient whole-of-industry analysis by a range of stakeholders to answer some critical questions, and these would range from the very fundamental: how much do small consumers actually pay for energy on average, and which retailers are actually the cheapest, through to the essential: do industry returns reflect an effectively competitive market, or is there evidence of persistent excess returns being earned by retailers? To illustrate the value we see in this idea, I'm going to very briefly outline some of the key outcomes from our work to date. The chart here shows retailer operating costs, or cost to serve, over time. AGL and Origin are there at the bottom, but it also includes Australian Power and Gas, a listed start-up energy retailer focused on small consumers. From 2007 through 2013, it provided a unique insight into the economics of a small standalone retailer, which grew from 6,000 to 353,000 customers across Victoria, New South Wales and Queensland. However, in 2013, and despite its scale-up, it slipped into losses and was ultimately acquired by AGL in some distress. This was due to its very substantial disadvantage in operating costs. These in turn were driven by issues which applied generally to smaller retailers: a lack of scale to spread the very substantial fixed costs of being a retailer, and relatively high costs to hold a customer base which, almost by definition, has a high propensity to churn. We wondered if what we observed here about these three retailers' costs, two very big and one growing from tiny to medium-sized, was generally true. And if so, how have so many small retailers proliferated despite their cost disadvantage? This led us to question the apparent wisdom that since certain measures of competition were improving, competition was therefore in fact working to the benefit of consumers, presumably via lower prices than otherwise. Instead, we wondered whether the particular industry structure was allowing an equilibrium where high-cost retailers could set prices at levels necessary to recover their costs, while the small group of large, low-cost retailers merely followed. This implies Tier 1s maximise profit through margin capture, accepting a very slow deterioration in customer numbers and volumes. It would suggest Tier 1s can earn excess returns over and above the costs of the substantial working capital required to operate and manage wholesale risk in retail energy. We're also aware of the context. The Tier 1s would not necessarily be thanked by politicians and regulators if they exerted their pricing power and drove out smaller competitors. This would sit uncomfortably with the annual reviews of competition, which tended to define progress and success in terms of increasing customer numbers, improving HHI scores, and high levels of churn. And if they were not really competing based on cost, it was also hard to imagine strong drives towards cost efficiency among the larger retailers. This sounds like bad news for consumers. High-cost competitors proliferating and setting prices. Little incentive among the large retailers to realise efficiencies, and therefore nothing to effectively constrain the impact of the very substantial new costs of competition which have been introduced. We think that understanding industry cost to serve and cost of capital are very important, and yet these are among the least discussed aspects of the cost stack. That in turn is due to a lack of industry-wide data outside of AGL and Origin disclosures. As the cartoon here shows, a cost-based view of competition recognises the very real new costs introduced: customer acquisition and retention under relatively high churn rates, advertising and marketing, and the replication of corporate overheads across many competitors. As Ron Ben-David at the ESC has pointed out, these costs are effectively unconstrained in a market which consumers cannot feasibly exit. The red line can just keep on growing. And in FY18, as I'll show you, it's very clear that is what it did for both AGL and Origin at least. Against this, we rely on competition to drive efficiencies to more than offset the new costs. But have they? In our view, there is likely a happy medium, likely to involve a small number of relatively larger Tier 2 competitors as genuine cost-competitive price setters. It seems to us that the only way to know where we are today on costs and whether we are heading towards or away from the ideal is to measure industry-wide retailer operating costs reliably over time. In addition, the best way to know whether competition is delivering prices based on efficient costs is to measure industry earnings, estimate the cost of capital, and so determine whether there are persistent excess returns over and above those costs. Only AGL's reporting is sufficiently detailed to allow for a basic check on whether persistent excess returns may exist. AGL disclosed the assets of their overall retail segment, and we can make some assumptions about how much capital is supporting small electricity consumers. We estimate about $380 of AGL capital was devoted to support each small customer account last year. If 9% is a reasonable estimate of their cost of capital, then about $35 of retail EBIT provides the necessary return on that capital. Anything beyond that represents excess returns or economic profit. As the chart here shows, we think FY14 to FY17 were very good years for AGL in electricity retailing. There's nothing wrong with some companies making excess returns some of the time, but we would expect them to be competed away eventually. We would not expect a large proportion of the industry to enjoy excess returns for any extended period. If it does, then it is a clear sign that competition is not effective. We simply do not know whether AGL is the exception or the rule. In our view, we should know and easily could know if AGL's standard of disclosure was extended across the industry as a whole. So I hope I've been able to illustrate how this source of data can already deliver some challenging hypotheses about how competition is performing for consumers. And perhaps I've also made the case for extending the specific analysis of an AGL or an Origin to a consistent whole-of-market view which could prove or disprove the hypotheses. So in conclusion, we think it's reasonable to ask all retailers to do what AGL and Origin have done for over a decade: release basic operational and financial metrics to support robust analysis and the resultant informed policy development and regulatory oversight. We propose a handful of simple measures. FinnCorn has specified these, and I am happy to provide them to any interested parties. As simple as revenue, gross margin, EBIT, capital employed, volume sold, churn experienced. We don't think the administrative burden would be large, since these are basic metrics which any retailer must already monitor closely. We think much of the data can and should be publicly available for wide stakeholder analysis to assess the overall position and direction of this industry. Thank you.